38% dividend yield. Sounds too good to be true? Well, let's see, is there a catch to this story? So, CVR Partners engages in the production and sale of fertilizer products in the United States. And in the last 2 years, their results were extraordinary. But recently, they published a 2023 half-year results. And the revenue is down by 12.2%, net profit is down by 23.7%, cash is down by 20.9%, and the debt did not change. So we can already see that it is not a stable, predictable business. But it does not mean it can't be a good investment. Let's see how it performed in the past. If you were to invest $1,000 in CVR Partners 10 years ago, you could buy around 5.4 shares, and today they would be worth around $463. So in 10 years, you would lose 53.7% of your investment. So that is pretty bad. But let's not forget about the dividends. Maybe they are able to make this investment worthwhile. Through the 10 years, you would receive $469 as dividends. So if we add the current value of shares and the dividends, we get $932. So that is a loss of 6.8% in 10 years. Well, it's hard to call that a good investment. But future results don't have to look anything like the past results. Or maybe the drop in price can actually create a great investment possibility. Let's find out. Individual insiders, that is an X, only 0.4% of the company is owned by individual insiders. And we would like to see this number over 2%, so unfortunately the management does not have its skin in the game. And are individual insiders buying? That is also an X. In the last year, we don't see any transactions from individual insiders. And do super investors own this company? That is an X. Not a single super investor owns this stock. So, of course, they are not buying. That is not a very encouraging beginning, but let's take a look at the financial health of CVR Partners. Return on invested capital, that is an X at 2.6% 10-year median returns. And we want to see this number higher than 10%, so that is a worrying result. And free cash flow growth? That is a check at 17.5% 10-year compound annual growth rate. And also here we want to see this number over 10%, so at least the growth looks nice. And what do we know about net profit margin? It is a check at 30.5%, and the industry average is just 9.7%, so that is very encouraging. And now let's take a look at share buyback. It is an X with 57.1% new shares issued in the last 10 years. That is very worrying. Long-term investors are getting diluted in a massive way. Let's take a look at the debt. It is an X. It would take 6 years to pay the long-term debt with a 5-year average free cash flow. And why did I use a 5-year average free cash flow instead of the current one? Well, current free cash flow is exceptionally high. So I want to be on the safe side and just take the average, and that way I'm not concentrating on short-term results. The dividend yield is 38%, so in the last 12 months, shareholders got $32.75 per share through dividends. That is an incredible result. And the payout ratio? That is an X at 120%. But it may be a little bit misleading. CVR Partners change their dividends all the time. It all depends on the current results of the company. So such payout ratio most probably indicates that the dividend is going to be much smaller in the near future. Okay, and what do we know about dividend growth? It is an X because, like I said before, the dividend changes all the time, and as you can see, there are even periods when the company decided to stop paying dividends altogether. So this dividend is a big one, but it seems very probable that it will be cut in the near future. Price to earnings ratio is 3.1, so this company seems very cheap at the first glance. But to properly value it, we will have to estimate the growth of CVR Partners for the next 10 years, and we will make 3 scenarios: low, medium, and a high one. And for this calculation, we will use a 5-year average free cash flow. Like I said before, I want to use it because the recent free cash flow is just so big that it does not really represent the company properly. If we use the average one, we are more conservative, and thanks to that, we have a smaller chance of making a big mistake. So in the low scenario, we will estimate a growth of 5% for the first 5 years, and then 3%. In the medium, 7%, and then 5%. And in the high scenario, 9% for the first 5 years, and then 6% growth. Now, why did I use such estimates? Well, if we look at the 10-year annual growth rate, we see that the revenue went up by 10.7%, free cash flow by 17.5%, and earnings per share by 5.9%. So our estimates are pretty conservative, and that is exactly the way we want them to be. And with such estimates, the intrinsic value in the low scenario is $81, in the medium scenario $100, and in the high scenario $117. But these are not the prices we should be looking for, because we have to always add a margin of safety. I use a 30% one, and that gives me a peace of mind that even if my estimates are wrong, I should not get into a lot of trouble. So with such a margin, we get in the low scenario $56, in the medium $70, and in the high one $82. And the current price is around $84. So I would not say that this company is cheap, but it may be somewhere close to fair value. Maybe not quite there yet, but not far either. So this company had great last 2 years, and because of that, they paid a very handsome dividend. But right now, things are going back to normal, and we should not expect such big dividends in the near future. I also really don't like the fact that they are diluting investors in a massive way. I understand that they probably needed cash to grow the company, but they also have a significant debt, so it just seems too aggressive for my liking. But write me in the comments what is your take on this company. Do you believe that the last 2 years are the new norm for this company, or just a short-term event that will not have a major influence on the future of CVR Partners? Thanks for watching, and see you in the next one.